Alright guys, glad to have you on board again today. We are Wednesday and therefore we're going to pay attention to updating our regular intraday forecasts. So I've seen since last week quite a lot of concerns, and specifically right now people having weird kinds of feelings regarding actual unrealistic stuff, like how big Nvidia's earnings will shift away from consensus. Like if Nvidia makes a 20% gap to the upside and the S&P inevitably goes all-time high, and if Nvidia makes a 20% down move against the market prices, then of course we're going to trigger some more nasty consequences of it. And it definitely feels stupid to you because that means basically just one kind of number, which many people actually arguably know about before the actual release, so lots of insider trading there, is actually going to defeat or make the market. And that's definitely heavily stupid to you guys, and it creates a lot of cognitive dissonance here. So I'd rather like to make it very easy on you guys. You shouldn't pay attention to this. Even though we have mentioned the problems inherently coming from those stupid market concentration and a lot of actual psychology in the market prices now, but we do mention that in the regular weekly updates or portfolio management updates on larger timescales. We have never and never will consider these things into the intraday briefings, and I would like to reiterate that statement clearly one more time. If you fall down this trap of mixing things all together and letting the dumb stuff pour into an intraday strategy, which should never pay attention to this, you're making mistakes. The reason why is that, remember, in here we have set a clear, absolute crystal clear set of rules, the kind of level that a 6-year-old would be able to apply blindly. To the point that all of these rules are clearly written down, black over white, easy to understand, easy to apply. And we clearly have said that the risk management comes along the actual uncertainty principle, which means despite those clear set rules, the market will do whatever the fuck it wants, and there's no way for you to control this. It's just you're going to have to embrace chaos, and we're just right into it now. It means there's a lot of elements impacting the market now that are much more complicated than this simple rule set we have defined. Yet, the only thing you should do is applying this goddamn set and not paying attention to external factors. The confidence in here doesn't come from the fact that you're going to make it this time around or the next one, but out of 100 trades, you'll definitely sort it out, which means the level of chaos, which you have no control over, is the kind of thing you need to accept. Sometimes it will work out in your favor, sometimes it won't. The actual truth is, over 100 trade, this goes negligible. And you need to test it all out together, to test it all out yourself first. Get to apply this and figure it out on a chart which you have no psychological context over. You basically don't feel the real-time emotion because you're looking at historical replay charts. And by doing this consistently 100 times, you'll see there's no way you can come up with 100 series of trades losing money in the end. And by just doing this, you understand that the only thing that separates you from this replay and the actual application in real time is your capacity to follow the rules without taking in account any other contextual information but the ones that you see on the chart. Remember that, we've mentioned that, you can assess and modulate the risk limitation of your trades based on factual information only. That's the reason why these indicators have been built, heavily complex, with complex algorithms filtering in themselves inside the process, which means you should see and trade what you see, not what you think, unless you see it. Which means, for now on, you might feel the heavily tension and so on, the stupidity of Nvidia, whatever. Remember that if you were looking at it in a replay chart, you would know nothing about the kind of Nvidia stuff, and you would still make 100 profitable trades, or profitable outcome out of 100 trades, okay? Not knowing anything about the context. So this time around, you know about the context, it happens in real time, it's impacting you day by day, yet you should play it just like you were on a replay, not knowing anything about this context, discarding it entirely. Okay? Well, that's really how it goes. I know it can be difficult to have access to information and discarding them, but that's exactly what you need to do if you want to be a good intraday trader. Okay? So that's really how it goes. Also remember that in here, even though we call that intraday strategy, we're still diving H4 time frame, which is kind of the largest possible time frame we could go down to for intraday trades. And these trades in here can take multiple months to actually play out. So it is definitely playing a game on the larger time frames. Yet Therefore, you should still discard those informations, okay? It might be painful to say, yeah, but for over a month, I get bombarded by a shitload of information, yet you should discard all of them. There's no big one that should pass through that filter. It's really a simple, nothing passes through. Okay, so nothing is important unless you see it on the chart. In here you have no volatility alert, no squeezing, no whatever. Apply the goddamn rules as they are. So quickly speaking, in here, to reiterate the conditions we're in for the technical black over white kind of rule sets which we know of, we have terminated the third flow. We had multiple sets of alerts to profit take in the process, which means from now on you should not be a bull. That doesn't mean the market reverses all its own. It can play its own game for as long as it wants to, but we're only going to wait now to get a first corrective bearish flow, which means I want to see this context falling below a flat or falling moving average. For now on, the moving average is still rising and the context is still rising as well. So there's no point for now thinking about the first bearish flow. So two things can happen, that the market go higher, whatever. So it means the only thing we're left to apply in here is the range strategy, okay? We can definitely apply it. Trending, daily is still trending, okay? Meaning, by trending, meaning the moving average is below the context, and we're not talking about trending in here, we're talking about excessive markets, but that's the thing anyway. So for how we can definitely trade, we have the moving average inside the context, so remember, figure out the maturity of your range. We've got delayed third range boundary here, context to context, rebouncing without making new all-time highs, and then you break and reverse the context. So this is first range boundary, second, third in delay, fourth, that means we're in the fifth range boundary in here. 4 range plus means you can trade with the DOM strategy, eyes closed, and that's exactly what I have done and talked about last week. Here was a perfect opportunity, get to be a bear in here. We had signals and everything needed. We had profit, we had breakout targets, so it was a clear, neat bear trade, easy to make. That doesn't mean you're going to succeed. It just means this is where you profit take, mid part of the range, and you can see there is an opposite bullish trading boundary at the bottom, which means you should also buy 5200. So that's really clearly, once again, you can fluff off your stuff with how big NVIDIA's earnings release will be, or how worse they will be, and how everything will collapse down with it. Just don't let it in. Don't let it sink in. The truth is, we don't care. All we need to update the flow sequencing is to see the first flow bearish elements, and we don't have them. And until then, you can trade this mature range with the downtrade boundary stuff. Okay, pretty damn simple. All right, now moving into crypto, it's the same thing. You can see there's volatility shitstorm all over the place. It feels like you're waking up and shit is hitting the fan. And even though on Bitcoin, we have mentioned the numerous and repeated volatility alerts on the chart, clearly visible on the chart, okay? We haven't had such for now on, which means if we have yet another one, you could prepare for potential volatility, which means get ready for some for some ride, and eventually consider expanding your stop sizing. But until then, if I were to zoom out and just switch to the Bollinger Band in here, so you would see the Bollinger instead of the trend channel, the thing is, in here, you would see this is where we had to buy. This is our first flow, our second flow, very long and extended, and so on, and we need to buy the lower Bollinger Band. So this is where we bought. We had one volatility in here as well, saying, yeah, kind of, folks, if you were definitely putting a tight stop loss, like putting a stop in here at 40K, I definitely think you can get wiped out. That's exactly what turned out to happen for Ethereum, because similar kind of situation in here. But once again, remember, this is where you needed to buy Ethereum, and you probably would have assessed that minimum stop loss would be there at 2200, and maximum stop was, of course, below the previous low point. So you know that this is the area in which you can assess where to put your stop loss. Bare minimum was in here, maximum is there. And how wide you put yourself into that system depends on the actual information you gather. So remember, on Ethereum on the 4-hour chart, which is the one you trade on, you've seen nothing actually relevant but that single-sided volatility alert, which in turn played out immediately after. So it was really the kind of thing in which either you got that information right on time and you applied the risk limitation, meaning if you had your stop loss set right in here, right when you see this kind of alert, oh boy, you really want to be putting your stops a bit further away. The maximum is in here. Nothing can put the stop any further than that. And that doesn't mean we're not going to get there. That just means you can't risk any more than going there. If we go there, the entire strategy is flushed out and you need to restart over again, take the loss and move on to the next trade. It's really as simple as it is. But we've also assessed the fact that if you were actually unaware of this, had put your stop loss at 2200 and actually ended up being stopped out, I definitely think that buying it again at 2400 now is a very viable outcome. You would definitely be like, okay, I should have reacted to an information that was visible on the chart. Very important. I simply didn't because for whatever reason I didn't see it in time or couldn't react in time because I was on vacation. That's exactly what I done. But lucky for me, I hadn't put my stop losses so quickly and so shortly. So the answer is, if and only if you've got stop, you can still take over that trade. Need to understand the consequence of it, which means this time around your stop is still the same, maximum there and minimum at the current low point. Okay? So somewhere in here is where your stop losses should be. The closer to the price, the higher the position sizing will be and the bigger your gains. But also understand that the higher the risks to be stopped out in another volatile event. So I would recommend certainly giving some breathe out there, but understand that so far so good. We haven't had another volatility alert on Ethereum to warn you about, yeah, I should definitely be conservative. I definitely think in here an average size is recommended. But if you've got stopped out by this stupid event when some kind of market maker decided to sell over an illiquid weekend for whatever reason, I definitely think this is the kind of trade you should consider taking back when you're on a rising moving average. So that's definitely the kind of thing in which I think if you've made some strategic mistake by not reacting to an information, that doesn't prevent you from actually taking the trade again. Also, just understand the consequences of it. If you are taking another 2% risk trade in here and end up losing both in sequence, you would actually lose 4% on a single actual trade. Okay, so that's really all there is. Understand that in here you're going to double the risk, so make sure you don't do these kinds of adjustments all over the place. But in here we tend to say the brutality of the event and the volatility, stupidity of the catalyst is actually, I think, definitely worth taking the trade again. Now that being said, I'm going to leave you guys with that. Remember that very clearly. The rules are simple. The only thing that makes them complicated is if you let yourself being stuffed with all of those external informations, which we clearly said shouldn't be part of the game, shouldn't be processed, shouldn't be nearly thought through. It's just meaning you're going to get bombarded by those informations. You just need to discard all of them unless you see them on the chart. The truth is in here, if you want to get yourself up to date by knowing that you trade on a 4-hour chart, and if you want to be notified by all the alerts, get to understand that you have the ability to do such a thing. You can use frameworks built in alert context. You can say alert me on all context, and in here basically you would be alerted on all the potential context detection. If you are an advanced user, you would have all these advanced context. If you have set the indicator to the simplest form, which is the ranging format, okay, it's just beginner. If you're just in the beginner stuff, remember that in here you will get yourself alerted for all those volatility alerts. Okay, here's how you would receive an update. You would have been an alert in here, an alert in there. That gives you information about the range. That doesn't mean these are tradable contexts per se. That just says these are kinds of market moves and market timings which should consider potentially important, or at least bringing potentially relevant information for a range trade. And that's all you need to know. You would do this, kind of putting yourself into this alert system and say, get me an alert on everything. Alert me on all contexts, okay? That's really how it goes. I will, of course, put out a release for an update sooner, which means I will consider renaming the squeezing alert into volatility alert, which means you will have a single stuff in here to alert you on volatility information stuff. That means combining both the squeeze. Remember, the squeeze means there's not enough volatility. Well, on the other hand, the volatility alert it says there is volatility anomaly detected by the indicators saying something fishy is happening and you should be cautious about potential harsh volatile move. Okay, so I'm considering this update. I'll push it probably in the following few days. I'll let you know, of course, in the Discord, and you'll probably receive a notification in a TradingView in here as well. That being said, I'm going to leave you guys with that. See you later. Bye-bye.